Today, on Full Disclosure, we examine the crisis conditions in the municipal bond market. Is the muni market going to crash? Is the late 2010 credit sell-off a trend? And why are there billions of outflows from the mutual funds? Should you sell your muni bonds? We'll answer these questions and yours live from the Performance Trust Studios right now on Full Disclosure. Hello, I'm Brian Battle, and welcome to this edition of Full Disclosure, Municipal Credit Examined. The $2.8 trillion muni market has been the subject of massive media discussion, congressional investigation, and regulatory scrutiny. Theories of hundreds of billions of default have been proclaimed, supported, and then ultimately debunked. As we're dealing with, are we dealing with a local budget imbalance or an actuarial Armageddon? Well, with these widely divergent opinions of the problems, how can you even know what's true or what's even possible? We have a great panel today of municipal bond credit experts, and we're going to discuss what facts you should know and what conjecture you should ignore, and most importantly, how to measure and manage municipal credit risk. Each of our panelists has over 20 years of experience analyzing and managing and investing billions in municipal bonds. Let's meet our panel of muni veterans. First, John Wilhelm. John has over 21 years of experience in credit research and portfolio management for municipal securities. During his 11 years at Nuveen Investments, he was responsible for approximately $3 billion of municipal assets under management that involved 9 different credit strategies. John has led a team of credit analysts who research industrial development bonds, utilities, real estate-backed financing. Additionally, he has extensive experience in healthcare and industrial development bond sectors. Bill Black. Bill is a portfolio manager for Van Kampen Funds at Invesco Van Kampen, which he joined as a municipal credit analyst focusing on high yield and corporate-backed borrowers. Before joining Van Kampen, he was an investment banker specializing in municipal bonds. Currently, Bill manages about $5 billion, primarily in the Invesco Van Kampen high-yield municipal fund. And lastly, Tom Futrell. Tom has over 25 years of experience in municipal bond portfolio management. He started out as a credit analyst with Nuveen Investments, and his municipal involvement has included performing portfolio construction, ongoing portfolio management of a number of closed-end muni bond funds. He also ran a research team that evaluated potential purchases and performed surveillance on credits totaling $60 billion. Well, thank you for joining us today. We've got a full slate of things to work on here, so let's just get right down to it. If you want to start, Tom, and say a few words or a little comment about what's going on these days.
Thanks, Brian.
Sure.
Yeah, we look at the 2011 as a year in which there's going to be a lot of interesting developments within the municipal market. One is the fact that Congress will likely not provide assistance to the same level that they have in the past, as demonstrated by the fact that the Build America Bond program has come to an end. It doesn't really look like it's going to have any legs at all as we move forward. There'll be a lot of volatility within the market, and we think the yield curve will continue to stay incredibly steep. We see state governments' balance sheets and finances improving this year versus last year, with the problems being pushed down into the local municipalities, counties, cities. And the last thing is I think we'll see improved disclosure as we move forward.
Excellent.
I hope you're right on the last point. That would be a wonderful thing. What I'd like to highlight, just to start off with, is that there's been an awful lot of press and analysis from outside of the municipal bond community in the last 6 months to a year, and I think that's welcome. We're all municipal bond experts, but at the same time, sometimes you can get too close in it. You can start completely believing municipal bonds don't default, and just kind of get into a mantra. And it's good to have people kind of come outside and call that question. At the same time, it's a very selective, very specific business. Municipal bond analysis is a very heterogeneous type analysis. You can't just fly in from 30,000 feet, drop in, and say that the entire industry is going to default. You really do have to have a bottom-up, selective approach to get there.
Sure.
The market is totally different today than the market that we were all participating in 2007. Back then we had a market 50 or 60% of weekly issuance came with that AAA rating by the bond insurers. As we know, they, one after another, have lost their AAA ratings, not due to any problem that occurred in the municipal bond market,
right,
but because of their attempt to grow revenues in the taxable market in securities like residential mortgage-backed securities and CDO squared and other acronyms. That's where they ultimately realize losses and have lost those pristine AAA credit ratings. So when we look at things today, there's actually more opportunities in the sense that now the market doesn't come as one homogeneous, AAA wrapped bond. You have to know credit, and today, yes, there are revenue pressures, there are expenditure pressures, but does that mean that there could be some sea change and a massive increase in defaults? We don't think so. But what we do think is that to take advantage of higher yields and wider credit spreads is that you need to do your homework. You need to do fundamental bottom-up research.
Right, so the bad news is there's no more muni bond insurance. The good news is there's no more muni bond insurance, right? The market's beginning to differentiate. And I think you're right, with 50,000 different issuers and millions of CUSIPs, you can't say the muni bond market is. It's a lot of different things. So getting to the point of municipal credit, where do you think the danger is? I mean, Bill, where does the danger lie? What are they really talking about?
I think the danger is very very selective, and one of the most dangerous words, 4 words in the business sometimes is this time it's different, and you can look at the Moody's default rate charts and all that and say, well, everything's fine, and by and large I think that's true. At the same time, you have to be very selective as to looking within credits to figure out which ones are going to have issues and which ones are not. As Tom pointed out, the states. It's my belief, and I think we all share it here, the states are not going to default. Their problems are going to get pushed down either A, onto taxpayers, or they're going to get pushed down onto people they've been allocating funds to, higher ed, social service providers, school districts, communities. Right. And that's where you have to look for how is each of those borrowers' ability to manage that stress of having their funds reduced. I'm here in Chicago. The Tribune today had an article on school districts and how even the wealthier ones are trying to figure out how they're going to get through this. And that's what you have to do, is go through each credit that you own or are considering owning and really look at that. Look at their ability to manage through the process.
Yeah, and it's definitely not, it's not because of the debt service requirements that municipal debt brings to any particular specific issuer. I think the average is what? 5 to 6% of their total expenses relates to municipal debt service requirements. Right. It's really the rest of the story, starting with, as you said, just the nuts and bolts of running whatever the enterprise or the operation is, to the long-tailed demands of pensions and other post-employment pension benefits.
So the budget decisions become political choices. It's not a financing problem. It's a political selection problem. So does that then beg the question? So is the problem going to be in small towns, or is it going to be in specific revenue districts? I mean, can you even make a generalization like that?
Well, I think this year the issue will be more directed in terms of credit strains on smaller units of government, cities and counties, especially those with higher than national average unemployment rates, maybe more concentrated economic bases. We're subject to a greater degree to the real estate recession or depression in some areas of the country. And what we're seeing at the state level first is that about 18% of expenditures 2 years ago were met as using federal stimulus monies. And then last year it was down to about 14%. And now we get into 2011, and by June of this year, largely that money will have been spent. So now what states are confronting, as Bill and as Tom have mentioned, is that they're going to have to get by on their own. They're not going to, in all likelihood, with the change in the November elections, get a lot more federal dollars. So what we're seeing is the states are cutting back expenditures that then will local communities will have to handle. And those that are least able to handle those will be those municipalities, as I mentioned, that have very high unemployment bases, very narrow economic bases, and that those who haven't exercised prudent fiscal management historically and now find themselves over their skis.
So the muni market won't crash, let's say, generally. I mean, it's so many different parts, the whole thing can't crash. Certain parts might crash or decline in value? Or even, let's beg that question, what does a muni market, what does a crash look like? Now, the newspaper describes a wholesale sellout of the funds, rates go up as a crash. Is that a muni market crash? Is when NAVs change, or what? How would you define a crash?
It's, let's start out.
You guys all have a fund experience,
yeah,
right?
Let's start out with the fact that the municipal market is the least efficient of all national markets. There are the 50,000 plus CUSIPs in the Barclays indices, all indices, 30 or 35,000 of them make up the municipal bond market. So it's diverse. It's it's very it trades by appointment only for a lot of the market. The issuance is for just all kinds of different enterprise demands and needs that these municipalities have, and so a crash in one area, whatever that crash is defined as, may have no impact whatsoever on another part of the. I mean, we could take Vallejo as an example, where the city filed Chapter 9, but then all the enterprise functions, the water, sewer, the electric system, on and on and on, they're still paying their debt service.
So munis aren't correlated to each other than through the aggregate economic activity of their region and the country. Because it seems that that's what's getting lost in the discussion is municipal finance in the media, and when they describe a crash, is that most municipal government is driven by their expense ratio, which is labor, tends to be labor, and then the overarching economic conditions. If there's a slowdown, if property values decline, that affects everyone. That's a chilling effect, but it affects everyone differently. It's not a net correlated 5% decline or a 10% decline, which we saw in the mortgage-backed market where there was a high correlation between housing prices across the country.
That's a good point, Brian, because that's exactly, to my mind, again, I'm just a muni guy, but that sounds like exactly what happened with mortgage backs. That the rating agencies, everybody believed that these were uncorrelated markets, that the Southeast would behave differently than the West, et cetera, et cetera. And it turned out that in a over-leveraged market where demand slowed for housing, in fact stopped, they became highly correlated.
Right.
If that was going to happen in the municipal bond market, I think it would have happened by now.
Right.
But there are ancillary fallout issues with that market in the muni market, i.e. Real estate tax receipts have gone down dramatically over the last few years.
Property values, right,
Yeah.
GO.
So there are some areas where there'll be correlations, but when you look, you mentioned about mutual fund flows, and what does that tell us? Well, if you go back to where we were last year, we had robust mutual fund inflows through September of last year, and we hit multi-decade lows in yields. I think AAA municipal market data, our version of the Treasury yield curve was at about a 3.7% in 30 years. And I think retail began to lose interest at that low yield level. At the same time, you began to have the announcement of the quantitative easing or QE2 program.
There's 100 basis points of Treasury change right there.
Exactly. And so you had a number of factors weighing on the municipal market, not credit factors by and large, although there was a lot of negative headline news. But what we were really experiencing is a Treasury bond market fading or declining in terms of price. We had mutual fund outflows, I think, reflecting those lower municipal bond prices that were tracking corporates. Then you had, on top of that, you had negative headlines, people like Meredith Whitney talking about $50 or $100 billion of defaulted bonds that could occur in the near term. And then finally, as Tom mentioned, you had the Build America Bond Program, and after the November elections, the real question of would the Build America Bond Program be extended.
Right. And it also, too, in the November election, that there was a change of feeling that tax rates weren't going to go up, they were going to stay low. So between Treasury rates rising, a change in tax code, and an increase in supply, that just drove funds down. Now, when you run a mutual fund, as you guys all have, you feel you get redemptions. So what do you do? What is the flow? How does that go if you're running a fund? You get a call, you get redemptions. What do you do, Bill? Do you sell your worst bonds first, your best bonds first? I mean, what's your reaction?
There's a variety of them, Brian. One of them is to look, depending on where you are and how much flow you do need to look to your most liquid bonds, just to sort of just start things going. At the same time, you got to make sure that you're balancing your portfolio. You don't want to sell all of your, sell all the pieces of art off the wall and then just be left with a disaster of a portfolio. So you start looking for other things. Interestingly, as you mentioned, I run a high yield bond portfolio, and there is some liquidity in high yield bonds. In Minnesota, for example, senior living is a very accepted product for a lot of retail. And in Florida, built out land districts, not the undeveloped ones, not the train wrecks down that caused problems in 2008, but the ones that are built out, there's a lot of liquidity in them, deservedly, because in a way they're almost like a little mini general obligation bond.
Sure. Is it true then? Is it true then too? Because what we've heard is that once the funds start selling, the NAV changes, that begets more selling, and does that cycle happen where people see the NAV change and then, or is that muted at the sales level?
I think you need to realize that the bill runs a high yield fund, which is vastly different than AA high-grade municipal debt. And so the pockets of liquidity and the demands regarding credit are, I'd say, vastly different from what, again, the AA 10, 20-year paper looks like versus, tobacco zeros.
So was the fund sell-off this time more of a reaction from the events that we talked about, or was it headline risk, or, you guys have been doing this a long time. Did you feel like it was different this time, that it was more headline-y, or?
I think really, you enunciated really well that I think first and foremost, I think maybe we could talk about it, but maybe 50 to 70% of this was just plain treasury rates went up. I think that's what really triggered it more than anything else. I think it was the end of the year, people looked at their portfolios, stock market started looking better, there was better headlines about the economy. The world economy looked better at the time, arguably made it a little different now. And a lot of that, I think, triggered it. I think really the negative credit press was really more almost sort of okay, I'm now going to pull the trigger. But it wasn't really the driver of it. And what we're seeing now is that there was huge outflows. I can speak for my fund and really just in general for Invesco Van Kampen, that there were large outflows. That's largely stabilized now. If I kind of go on to other buyers that have stepped in into the market and caused some of that stability, was we have been seeing a lot of crossover buyers. One of the first groups that started coming in and saying, wait a second, some tax-exempt bonds are cheap. We've been talking about how there's different kinds. Corporate-backed bonds are very easy to compare. A Federal Express that's tax-exempt versus a Federal Express that's also an unsecured credit that's taxable. It's a high-grade bond, or at least in my mind, about an A1, I believe, somewhere in there.
I'd say that too.
Yeah. And when tax-exempt yields were actually higher than the corporate yield, crossover buyers realized that eventually, this was going to revert to the mean, and they stepped in and started buying.
Do bond holders, do people in a mutual fund, are they pretty sticky? Will they hang in there and it really takes something to force them out, or is it sort of a tide in and out, kind of a washing in your experience?
Well, I would say that as you got further along in the recovery, so if you looked at how illiquid our market became in the fourth quarter of 2008, and then we had a dramatic recovery in 2009 through really the first 9 months of 2010, you had more what I would say is hot money or short-term players. And you also had on the other side is you had some people who had embedded some very strong gains if they had held over that time period that I referenced. So I think what you did was you cleared out some of the money that wasn't as long-term in orientation. And in the mutual fund space, you eventually get to a price and a yield where maybe there's a bit of fear in the initial move down in NAVs as you described, but eventually you look at yields and taxable equivalent yields and then you compare them to equity returns through time and they become very attractive. So there's that self-corrective mechanism as you see NAVs come down. But to Bill's point, to me one of the significant and very important differences in the current market versus where we were at in the fourth quarter of 2008 is that you have crossover buyers, you have much stronger banks. And so you have other institutions, insurance companies. In the fourth quarter of 2008, we had
all sellers.
Banks,
all
insurance
sellers.
companies,
hedge
funds, all
money
selling
market
at the
funds,
same.
yeah,
Everybody was on the same side of the boat.
Right.
So while we went through some pain with very significant mutual fund outflows, there was ready buyers as the market cheapened up. As we got to muni yields that were 112% of Treasury yields, a lot of people said, hey, this is a great opportunity.
So since the muni market tends to be this stable, we've got long-term permanent borrowers like municipal governments. the fact that it seems almost impossible for there to be a crash, and it's been a sleepy industry for a long time. But since '08, and now we've got it again, maybe we're going to get away from this notion that there's going to be a crash, and maybe just there's going to be more NAV swing. There's going to be more price swing. There's going to be more credit events, just like every other market. So,
well, it could hardly be any lower than it's been in the historically speaking. Nominal cumulative default rates have been, you know, even for lower investment grade munis, has been virtually nil. So, you know, and as we've said, it's not always going to stay this way.
Right.
And so, with the volatility of the general market and then volatility in the retail space, you know, the muni market is driven really as a retail investment vehicle, and so 70%, I think that's about the number, 70% of all municipal bonds are held through mutual funds or individual bonds by individuals, and so finding these on the margin buyers, whether they're you know, corporate treasurers or they're hedge funds or well, insurance companies wouldn't be considered on the margin buyer, but you know, when they start to get profitable, they come back into the market in full swing. This is why this time, you know, this time through the first part of this year versus the end of '08, early '09, we've seen a lot more self-correcting flows.
sure, and the references to the Moody's credit default. So they studied defaults from 1970 to 2009, and all rated munis defaulted 9/100ths of 1%, and all global corporates that were rated defaulted at an 11% rate over that same time frame. And then all non-GEOs, munis, defaulted at 19/100ths of 1%, and all rated GEOs at 1/100th of a percent. So if the muni market's going to crash, you'd say that's an experience that's 10 times worse than it's ever been. You'd be touching a 1% default rate.
And you'd still be under corporate default
But
rates.
history, as we've learned in the past couple of years, history isn't a great predictor these days. Everything's different, right? I mean, you can't experience that. So I think that it's going to be different in its subsets, right? I mean, project finance is going to be under stress. You know, an aquarium deal in Tucson might be a little bit more risky than a toll road in Pittsburgh.
Exactly, and if you looked at that same Moody's data and you looked over that 39-year time period and you looked at where the majority of those defaults occurred, they occurred in housing projects, multifamily housing, single asset projects,
Right.
and hospitals.
Right.
When you look at what's happened over the last few years, you look at more of a real estate component in this credit trough. So special tax bonds, like in Florida, as Bill was mentioning, they're called community development districts.
Right.
They were a very significant portion of total defaults were in one state, one specialized sector in 2009. And you also saw real pressure in other higher yielding subsectors like the senior living sector. So I think you're right, it's going to be different, but this time, as you might expect and logically thinking, where it's been mostly impacted is in those credits that have the heaviest aspect or exposure to the local real estate market.
And that's to say, too, I mean, I don't want to say, oh, you can just straight and extrapolate what Moody's says, or I think it just puts a scale on it. You know, if it gets 10 times worse or 100 times worse, you're still at a small number. And I'm not saying, like I said, Moody's not predictive. It's just putting some sort of scale on how big a problem this has been in the past. It's going to get worse. I think we can all say it'll get worse. It's like every family's unhappy in its own way. Every muni default is going to happen in its own special way.
That is true.
Let's go to our second point now. Can you believe everything you hear about municipal bonds? And does it matter who's making these claims? And I think you referenced it exactly earlier on, that Meredith Whitney made a claim that there's going to be $100 billion in defaults, $150 billion in defaults. And I have a prop actually here, and Meredith came off the ledge yesterday, this weekend a little bit, and she said, well, there's going to be defaults, but it's going to be over a longer time frame, and gee, these municipal governments are getting their act together, and I'm kind of proud of myself that she brought this issue to their attention. So she can take credit for that, and I think she's right. I mean, she did bring attention to bad disclosure or latent, slow disclosure in the muni market.
But it had already started.
It had already started,
yes.
right? And municipal government does make adjustments to make sure it exists into perpetuity, because that's what they do. But excluding Meredith Whitney, who do you listen to? You know, what are you watching for? What stuff do you read to sort of keep track of the muni market? I don't know if you guys want to volunteer. Sort of, what papers you read? Like, is it the Bond Buyer? Is it Forbes? What is it?
For me, really, it's it's more almost business periodicals that are related to what I focus on. For example, when we have real estate problems down in Florida, I'm reading, number one, I'm reading the local papers down there, but I'm also just reading the trade journals that are talking about what's going on down there. So I've become very, for example, I follow the airlines. There's tax-exempt airline bonds out there. I follow those, so I go to a lot of conferences and get the information there. We get a lot of sell-side research. I think you really have to educate yourself on who is bringing it and for what purpose. There are some that I think you get a very much an honest opinion. Others, as an example, without naming names, I saw a research piece that talked about actually the Bronx parking garage, which is the New York Yankees parking garage.
Right.
And okay, exactly. It's just kind of curious. It's suddenly they're for sale by that same firm, and how about that?
Makes sense.
So you got to be cautious about what you read. But at the same time, there's some very bright people on Wall Street, very bright people with some of the regional firms.
But some of the information you have to get is from the financial disclosure. You have to read the financials from that issuer, right? I mean,
well, absolutely. When you're thinking in broad terms, as you mentioned, Brian, you're going to look at the bond buyer. You're going to look at the Wall Street Journal. Analysts and portfolio managers will do specialized research. In hospitals, you might read Modern Healthcare, for instance. But at the end of the day, if you're a fundamental bottom-up research investment process like we employ, then you're going to be looking at financial statements, talking with management teams, looking at utilization trends for a hospital, as I mentioned, inpatient admissions, outpatient admissions, those key credit metrics that will really drive performance and cash flow at that individual borrower.
Sure.
Really exciting stuff. That's it's gray-haired guys reading this.
Now, for the average investor, I have a question here. So that's how you do healthcare and stadiums and casino revenues. But what about a GO, like a school district? How do you measure credit, or how do you do surveillance on credit on a municipal bond, just a regular old school district? Is that something that you have to be watching that closely?
We'd say yes. I mean, the process of bottom-up analysis doesn't end with just high yield. Obviously, there are cycles that if something's a AA, we think it probably has a lot more built into it than a single B airline bond. But you look at the economic statistics, you look at the economic base of whatever that GO, wherever that GO has been issued. You look at the diversity of the human capital and the employment base, and try to determine how well it can withstand downside risk. You look at the management of the enterprise and the municipality. How strong are the people who work there?
But local GOs are driven by property taxes. I mean, if school districts, park districts, cities, towns, counties, that's a property tax business. Aren't we on the edge of that? Aren't we nearing the edge of a property tax meltdown? Isn't that the big problem with local credit?
Well, that'd be something to, again, you have to look at on a case-by-case basis. For example, I would warrant, I'm sorry, can give another Illinois example, the Village of Schaumburg. I'll just keep doing it.
That's okay. That's where we live.
Yeah, they have a gigantic mall there, so a lot of theirs is actually sales tax based. Property tax is probably a relatively low component. Other states, for example, go to the state of Florida, for example, is heavy real estate. I believe it's a real estate transfer tax, which is, in my mind, is almost worse than a real estate property tax, given what's going on down there. And tourism, that's their two sources. They have no income tax. So when you look at the state of Florida and the state where they're in, you have to really start thinking about that, as opposed to another state, or you look at, and gosh, I'm trying to find a positive example here. North Dakota, I guess, would be a positive example. Good luck finding any.
Yeah,
but North Dakota is a good. You've got minerals taxes and a variety of other resources that are actually in a positive state. Yeah. And so
oil shale, all the rest
oil
of them.
shale, exactly. Yeah. So you really do have to kind of see what kind of variety of resource they have. One of the things I think is important too is just plain look at both you guys have said it, is look at the fundamentals. If you've got a city that is rapidly losing population, that has incredibly high unemployment, and really perhaps some of their inner city land is turning into farmland, you really do have to kind of question how that's going to turn around.
It's really a function of political will, right?
Right. So that gets to my next question. I just got one here from the internet too. How would you rank management versus economic fundamentals? So is it more what's going on in that town or who's in charge. Now, Ted Damitz was here from Moody's a couple of the last episode, and they have management ranked very high because the economic fundamentals are knowable. You know how much assessed value is. You can kind of project, unemployment. You know who the top 10 taxpayers are. So managing the expense side is a way bigger deal for Moody's than even what's their debt profile. Would you agree with that assessment? I mean, is management that important?
Absolutely. I think the poster child for that is the state of Illinois, where
Let's talk about New Jersey.
Yeah.
Okay, let's change it.
But when you think about multiple years where you didn't address structural budgetary imbalances at the state level, that really isn't an ability ultimately to pay. What that is ability to reach political consensus. So when you think of Illinois having the lowest state credit rating at A1 negative by Moody's, for instance, that in large part was an inability to confront structural budget deficit issues, not making pension contributions, and not being able to find the political will to ultimately reach some sort of consensus that would drive a stabilized budget. So what we finally saw after the November election was a significant increase in state income taxes, right, which got us part of the way there. And now we've got to tackle other issues like pension reform.
Well, can we, given that these same governmental guys are in charge, can we trust municipal disclosure? It's always late. There's always a lag. Is that ever going to get better? I mean, is there ever going to be where the municipal credit financials are like corporates, where they come out every quarter and they are issued right away? So are we going to ever get there? Or does it matter? Is municipal credit that volatile where you have to see the financials every quarter?
I think it depends on the sector that you're talking about. Certain sectors in the municipal market, especially those driven by that are corporate backed, or they have a single revenue source. Those are very important that you get that information on a timely basis, and we already see that happening in the muni market. Where you don't see it is with, as we've talked about, GOs or municipalities where they come to market once every decade, or right, they're not rated, and so the disclosure tends to be not as timely.
Well, I have to give it to Meredith because she did say municipal disclosure is awful, and she did bring that to everyone's attention. And the great hurdle that we made is Emma. You can go look at financials. All have to be disclosed and posted on Emma, and it levels the playing field anyway. You can see current financials.
I think what it does point to, and this is a shameless plug for municipal research, is that you have to have someone who's watching the store. You need analysts, especially now that the market isn't a homogeneous market. You need someone to do the heavy lifting, the bottom-up analysis, someone who rolls up their shirt sleeve and looks at the balance sheet, looks at income statements, talks to the finance director, right, who is willing to, and when you're willing to do that work, you then know 95% more than the rest of the market.
So wait, so can you hire that out then? Can you hire Moody and S&P to do that? If you're on the top of the credit stack for school districts and park districts and cities and counties, can you hire Moody's to do that for you, to do that surveillance? Meaning, can you trust their rating?
Well, from my experience, at the initial issuance of a new debt issue, oftentimes we're not that different from our internal credit analysts. We may be a notch or two up or a notch or two down. Occasionally a full ratings category. But over time, I think what becomes critical is your ongoing surveillance. And that's where I think sometimes the rating agencies haven't been able to keep up with all the bonds in their rated universe. And we've touched upon defaults, but we haven't talked as much about credit spreads. Right. And if you looked at the 10-year portion, the 10-year maturity of the municipal yield curve, it's at about a 3% for AAA, about a 4% for single A, and a 5% for triple B. So while you might not have an out-and-out payment default, it's still going to sting if you haven't done your surveillance and you fall in a full ratings categories. And to me, that's the real issue, is because we would say, well, defaults will remain relatively rare. credit rating downgrades are going to exceed upgrades again this year like they have the last 2 years. So doing that ongoing surveillance and capturing those credits before they've become a fallen angel and gone below investment grade or fallen below full ratings category is what's critical to maintaining and retaining value.
We find the rating agencies often as almost more of a of an arbitrage or of a foil in a sense. Like you guys, we've always been a believer in surveillance. We don't do it by exception, like, you know, oh my gosh, something bad happened, quick, get on this case. You know, triple Bs are done every year, single As are done every year, lower grades are done, you know, much more often. And that enables you to, when S&P still has a triple B on something, and we believe now it's a double B, we know that, you know, in terms of pricing, we know whether to buy or sell, or occasionally it's the other way around, because S&P is just not able to keep up. We know that something is improving, and we're able to buy that in anticipation of an upgrade.
But your antenna, your surveillance antenna should be higher the further down the credit stack you are, right?
Absolutely.
Or the narrower the revenue stream.
Absolutely. And we have, for example, we have 10 high-yield analysts that are looking at it constantly, and again, on a quarterly, semi-annual, or annual basis. And that's what you really have to do. I think a lot of us learned our lesson with the insurance company debacle, is that you just can't just rely on a triple A being out there forever and everything's going to be fine. You really do have to understand the underlying credit.
So if you're doing surveillance, or if you're watching a credit, or you're not sure, you know, you're kind of getting iffy on a name, what makes you sell? What's that one thing you're like, holy cow, the assessed value declined 2 years in a row. Oh my gosh, they're burning down the debt service reserve fund. Is there some marker? Now, I'm trying to generalize a market. We just said you can't generalize, but what is that first signal that you see that tells you there's trouble in paradise?
I'll go first, because for us it's radio silence. If we check in and there's been no surveillance for a while, can't get. And that's exactly it. It's suddenly there's nothing going on. You can't get anybody to return your call, and you know, nobody will see you, nobody will talk to you, and there's no. That's not a good sign. That's a red flag.
Another one is when you can't get a bid, so nobody wants to buy them.
Might be too late then. Right? Yeah. Exactly. So what would make you sell that at the market? Or would you try and do workout? Or would you, if you have a position that you think is in distress, do you sell it? Or if you're not sure if it's distress and the market drops out, do you add? I mean, what's your action when you feel there's stress in a market?
Well, that's part of the surveillance process, is to make an affirmative decision of buy more, hold, or sell. So part of that surveillance process will be looking at, well, what is that bond yielding? What is its spread, credit spread over AAAs? And where do I think I could sell it today? Is that already priced at a level that's actually below where we think it'll ultimately end up in terms of credit quality, or is the market not aware of, let's say, this declining credit situation? So first you do your homework, and you're going to look at key utilization statistics depending on what sector it is for higher ed credit, enrollment, tuition per student, those kind of metrics. We talked about hospitals and admission trends. All of our different municipal sectors have their own unique utilization statistics, which are key. Then you look at the financial metrics.
And most utilization statistics, we're talking about revenue bonds or projects and stuff, right? I mean, we're not talking about school districts.
Right, exactly. More on the revenue bond side. Then you're going to look at the things you would think about for a corporation in terms of operating margins, debt service coverage, and leverage and liquidity metrics. But ultimately, you're going to take that credit information and investigate in the market, where do you think you can sell that bond? And if you can sell a ratings category above where you think it ultimately will be in terms of credit quality, then you would sell. But if it's already, let's say it's at an A and it's already evaluated or going to trade like a double B, then you might say, okay, well, we're going to take advantage of other people selling and take that as an opportunity to buy.
Right. So the stress in the market might be, or the muni market crash might be price. It might just be lack of credit, and a downgrade forces selling, and then funds will buy it.
We've seen that in the past, though. I mean, to varying degrees, you know, in different levels, where when a municipal bond goes through stress, it's very seldom an issue of default, not default. It's really valuation and volatility within the valuation of that security. And then if it were to go into default, then it's just recovery rates. And again, in that Moody study, when you add to that the fact that they have really low default rates, also munis tend to have higher recovery valuations than corporates. defaulted corporates. So, you know, at every turn, we see, you know, that's not surprising. We're in the muni market, but we see a lot of value in that.
Right.
So,
So here's the rude part of the show. Everybody's probably owned a defaulted bond, right? So ultimately, if you run a high yield fund, that's part of the process, right? Is you buy high yield, and some work out, some don't. So what was your? Why don't you explain? Maybe give us an experience of what it was like to own a defaulted bond. You didn't see it coming. It defaulted. You got 20 cents back on the dollar, and you moved on. Or how's the process go?
Well, for our investment process, it was very formal, where we would have an analyst and a portfolio manager and someone in our legal group working together to come up with a quarterly report where you would look at the fundamental credit attributes of whatever bond sector that security was in, and then you look at its current evaluation, and as we were talking about, you try and make an affirmative decision to buy more, hold, or sell. Sometimes you might have to go and get a real estate appraisal. You might have to hire professionals to make sure that security interests you have, like a mortgage, is being enforced. You might have to go ahead and foreclose upon that mortgage. But basically what you're trying to do is look at those security interests. Hopefully you negotiated strong provisions up front, and you know what you have. And that's the great thing about higher yielding municipal securities, unlike corporates, is most of the time, the vast majority of time, we're secured creditors. So you are first in line. We're not like a corporate junk bond. So we're going to be at the front of the line. We get people's attention when we have a first lien on revenue plus a mortgage pledge.
Sure.
So what you're actually doing then is trying to decide, do we work with the borrower? Do we kick them out? Do we have to foreclose on the mortgage? But ultimately, the decision's simple. What's the highest present value recovery? What does that scenario look like? Do we sell the bond now? Do we do the lift and go through the workout process? Or do we actually need to try and buy more of the security and try and gain greater control of the situation?
Now, we're talking about high yield funds where you know you're going to take losses. And a lot of the people watching the show are going to be financial institutions. It's going to be insurance companies, it's going to be credit unions, it's going to be a bank portfolio that are a lot higher on the credit stack. Are they, do you think, required to be doing all of this active surveillance? Should they be in there checking the financials, calling the issuers? Or is their due diligence lessened somewhat because they're in a different credit bucket?
I would think that you absolutely need to continue to do active surveillance. Maybe not to the extent, you know, especially in the higher grades, maybe not to the extent certainly that my firm does. Yeah. But in the end, as I think it was you were saying, Tom, I mean, or not just John, but when you talk about dropping from a single A to a triple B, that can have ramifications, one in terms of the price of the bond, of course, and the other is in terms of whether you can hold it or not, I would imagine.
Yeah, and that's a material event, too. I mean, you're going to know that happens. It's not, you're not going to lose. And we've already, I think we've had the cataclysmic event in the muni market in the past 20 years is when the insurance industry dissipated. I mean, whole just categories of bonds lost their ratings and went to non-rated or to single A on the underlying. So we might have been through that already.
To Bill's point, the fact is that you know, research credit through this day and age, it becomes more and more important as time marches on. And so again, with the volatility that we see in the market, the volatility that the people who are watching this show see in the market, they need to not be naive about the fact that a rating change, not a default, not even anything that really calls into question the fundamental credit worthiness of that security, just a change in the rating category can really hammer the value of that bond. And so that's why you need to be on top of your game when it comes to this process.
Well, that's a convenient segue because the last section I want to get to before we get too far along is municipal credit, and that's our fourth point. Let's talk a little bit about credit specifically.
Have you been talking about it already?
Well, yeah, it's all part of the show, but we're going to get real specific. So, now you're all high yield managers, but you obviously understand what's going on in the entire market. So, if you're going to own an essential purpose revenue bond, water, sewer, gas, and electric, what are you going to look for? What is the first thing that springs to your mind when I say essential purpose rev? What are you going to look for in credit?
If we talked a little bit about general obligations, but let's handle the other two, water and sewer and electric. Mm-hmm. Oftentimes the critical issue is the relationship with the regulators as far as getting rate relief. So if they're having to, as a water and sewer system, do capital expenditures to meet with Clean Air or Clean Water Act mandates, then you have to have a regulatory relationship where you're likely to get favorable recovery. Otherwise, you may have issued bonds and done the capital expenditures, and then you've got this new facility, but you're more levered because of the debt you issued. You need the regulatory relief to be able to then charge
Raise rates.
Raise rates. So to me, when I was a utility analyst, which is how I started, that regulatory relationship was very important. And coupled with that, as I mentioned, because there are going to be ongoing capital needs, oftentimes because of either Clean Air or Clean Water Act, depending on what type of utility it is, you need to be aware of what that capital expenditure program looks like. Because just that very fact that they may have to double the amount of debt and they may be a frequent issuer, you want to know that, because that's going to impact the marketplace if they're a very lumpy issuer of coming to market with $500 million bond issues every year.
But you can overcome a lot of that, though, by looking at the Moody's credit report. It says we have a rate covenant of this. We can raise rates to, to meet expenses. We will not let our, we have an additional bonds test of this, and we won't go below 1.25 times coverage. I mean, that gets over those hurdles, doesn't it?
Well, if you have rate covenants, then that is a legal right, but then you can still have the decision by local managers as to whether they'll initially fully live up to that contract right. So you want to look at the history of whether the managers of that facility have made timely rate request increases.
Back to management. How about, now this is a little bit more in your wheelhouse, how about a housing rev? If you're looking at a housing deal, how would you, and I guess there's two housing markets, right? There is an apartment building or a dirt deal outside of Houston, and then there's the State of Virginia Housing Development Authority. So
Yeah, actually, I would say there's sort of three. You're right. Because
Okay.
again, we bifurcate everything in the muni business.
Right.
I won't speak to the state HFA type bonds, but if you look at the multifamily and the land back deals, are two very different animals. One is exactly, as you say, sure, you can have a covenant there that says you have to maintain 125 coverage, you have to raise rates sufficient to do that. Well, if nobody wants to live in your apartment building for $1,000 a month, you're going to be constrained. And that's actually true of water and sewer, toll roads, just sort of throw something out in general on toll roads, and really in general on a lot of other properties. Check the debt service. Level debt service will save you a lot of the time versus a rising debt service that's making assumptions about inflation or rising usage. And toll roads are absolutely notorious.
Let's not talk about them.
I know.
That's any predator crab, is how many assumptions are you making? Are you building a toll road from dirt, or are you talking about the Illinois toll road and they're making an extension? I mean, you can make some assumptions about usage, and that's a very different thing from just a project deal.
And I think to close the loop on housing, obviously in single family state agencies or even local agencies, I think it's just really the quality of the mortgage loans embedded in that debt service and that bond. There's also enhanced multifamily housing debt, but that becomes more rare as time marches on.
So in municipal credit then, do you think, so let's talk about back up, I keep bringing us, you guys are all high yield guys, bringing us back up the credit stack. Do you think is the macro more important or the micro? So if I own a school district in DuPage County, is it more important as how they're running that? Do I have to know every little detail about that school district, or do I have to know how is it going in that town, how's it going in that county, how's it going in the country? Is it macro or micro more important the higher you go on the credit stack?
I think for the higher rated GO credits, you really want to look at what the long-term fundamental macro trends are. So you want to know about population growth or declining. You want to know about unemployment trends. You want to know about employment diversity. You mentioned earlier assessed value, full value trends. If it's declining, how much is it declining? Those are the factors oftentimes that are really then be the indicators of what's going to happen to them financially. Because what we have right now, we don't have a leverage crisis with general obligation credits. What we have is a revenue and expenditure crisis.
Right.
As people had mentioned earlier, typically for a state, for instance, or even at the local level, interest payments are under 5% of their budget.
Right.
But what's happened is that those big macro trends have caused revenues to decline at the same time service needs have gone up. So you want to have an understanding of just how diverse is that economy, and ultimately if it's got population growth, even though current revenue trends may be going down, you feel like you'll be able to come through the bottom and you'll be in good shape again.
Yeah, I've heard it described as municipal government is experiencing a budget problem, not a debt problem. And when you get to that point, so they've got to solve this budget problem, they're going to have to make a political decision. either to cut expenses, which is the majority of their carrying cost, or are they going to injure the bondholders, the people that lent them the money in the first place? And that it seems like an easy political choice. Well, let's give it to the rich bondholders. Let's get rid of them. But you're cutting your nose off to spite your face because municipal government functions on borrowed money.
And if you do that, and then you have problems accessing the market the next time around, there are only 6 Chapter 9 defaults in 2010. There were 10 in 2009, and so governments understand that is not a process or an approach to solving their financial problems.
Right. So in the muni market too, then we have the short-term budget, fiscal. We got to figure out how to balance a budget this year, and then the part that we haven't talked, the elephant in the room, is the pension obligation, actuarial problem that municipal governments face on top of the other post-employment benefit, the OPEB expenses, the medical benefits that they've promised. What is the scale of that problem, and do you think that that is dangerous, damaging, or going to be Armageddon for municipal government? Is a pension problem that big, and is it solvable?
Yes, it is solvable, and it's a problem, and it's been a growing problem, and the size of the problem depends upon a lot of different assumptions, including what type of discount rate you use, and we've seen the statistics, $1 trillion to $3 trillion. But again, if you put it into context, and you look at unfunded pension liabilities at the state level, plus net debt outstanding, and you look at all 50 states, it's about 6% of gross state product. So it's a relatively low number compared to if you looked at the G20 industrialized nations, it's over 100% when you look at those. And so the high states are at about 15% of gross state product. So it's not to say that it's not an issue, because it is a growing issue and it needs to be addressed. And as we've seen, as related to pension obligations with Americans living longer, I don't know if we can afford to have people retire at the same age that they could 20 years ago because they're living longer. So those are the issues that states will have to confront now. But when I think of it in those two metrics, in terms of what is that obligation as a percentage of debt service and total debt compared to gross state product, I think it's a manageable issue.
It's a long-tailed issue, absolutely. And the fact of the matter is people are going to have to work longer and save more. That's just the bottom line.
Right.
And we see the battle lines drawn at the state level, in one of our neighbor states, and
both of our neighbor states,
both
Indiana and Wisconsin, right?
And so the fact of the matter is that's just a taste of what's to come.
Right, and it is. I think that's also lost in the media is that there's this crisis, and there's a $3 billion or $3 trillion pension problem. There are two different time frames.
There are only a couple. Well, Illinois happens to be one of them, but most states, one of the rating agencies did a really nice report on pension liabilities and the funding issues, and it's not a national issue. It's not a national catastrophe.
Right.
There's pockets where there are issues, but it's not something that's widespread, endemic, and Armageddon.
Yeah, well, we heard that coming out of Washington. We're here from the government. We're here from the federal government. And we're here to help because they wanted states to declare bankruptcy and they wanted to guarantee pension obligations. And that talk, Paul Ryan and some of the other subcommittees in budget and finance have had hearings that have been very responsible about, okay, do we need to bail the states out? And John Shinsheimer from Illinois and Bill Lockyer from California, two of the biggest problem states, have said, no, thanks. Leave us alone. We don't want your help. We'll figure it out ourselves. So I think that talk has been minimized because maybe if we get federal government intervention, we will have $100 billion in defaults because if you bail out Michigan, then you have to save Illinois, then you have to save California, and it leads to that cycle. But I think that talk is over. That was a big deal at New Year's. We heard it a lot when we were out in Washington, and that seems to have run its course a little bit. But it seems like a long tail, and since it's taken a long time to get here, we got a long time to fix it. We just have to start now.
There's a couple of, they are two different issues in terms of defaults are caused by a liquidity crisis. Pensions are not going to create a liquidity crisis today. Liquidity crises are caused by either A, running out of money, or B, inability to roll over debt. And one of the things that's important, fraud. Good. But let's hope we don't have that at the state level. But when you think about governments, one of the things, too, is that the debt, by and large, amortizes. And I think it's a very important thing that gets lost sometimes. It's not a big bullet that comes due 5 or 6 years from now, like a lot of corporations do, where you need to look at how are they going to roll that debt over. The debt is amortizing. So even as you're putting more debt out there, you are reducing debt year by year. This actually is also a cause for demand in the municipal bond market because your bonds do mature.
Right. And getting back, like you just said, default. The thing about default too is it doesn't tend to be from declining assessed value, declining population. Towns just don't dissipate. It's different every time. With the time that we have left, I want to do a couple of anecdotes here. Jefferson County, Alabama. Jefferson built a $2 billion sewer system. They did derivatives. They have hedges on, and the whole thing blew up in their face. So they instituted a local income tax, and the judge just ruled the income tax invalid. What's going to happen in Jefferson, Alabama?
Well, they hit if they don't get the state legislature to reenact that tax, then they could have real liquidity issues come July. So they're going to try and depend upon their state legislature to enact an occupation tax that will pass muster as far as the court system is concerned, and then continue to work through. The central issue was this multi-billion-dollar sewer system that then they made a decision to finance over short-term variable rate debt. They had hedges on, the bond insurers struggled financially, and their borrowing costs are a lot higher than they had visioned. So to me, the lesson learned is a couple-fold there. It's one that they went into this massive capital expenditure program, and then they tried to finance a good portion of that debt through short-term variable rate financing and used derivatives that apparently they didn't know all the risks that were entailed of using them. And I think that that's illustrative of a story that's rather unique.
So it's not a muni story, it's a financing story.
It's more of a financing story than, to me, some fundamental did it work, did it not work story.
Right.
There was a disconnect in that situation between bankers and their funding, their creative funding techniques versus the people who actually ran the facility and what they understood about municipal derivatives.
So by June or July, we could have possibly the biggest muni default, certainly in the last decade, and maybe ever, depending on how broad the circle gets in the default. It's Birmingham, it's the state capital, so it's not a good story. And it'll be one that'll be replayed in the popular media, and hopefully they'll get a little bit more nuance in there. Same thing I wanted to mention, Vallejo. That's Vallejo, California has been mentioned 1,000 times, and oh, they're stressing the muni market, and the newspaper or the media will say, just like Vallejo, California. And what happened in Vallejo was that the public employees unions had robbed the piggy bank. I mean, the fire chief was making $300,000 a year. They had long-term promises. And the guy who was on last time, Jim Spiato, said, Chapter 9 is the worst possible way to settle this because nobody gets what they want. The only guys that get paid are the lawyers. It takes a long time, and the outcome is suboptimal. Is Chapter 9 bankruptcy going to be more used? Is it going to come to that where public employee unions are going to go to the mat and force government to declare Chapter 9 to get out?
You know, I really don't think so. I think the Chapter 9 Vallejo case was really a kind of a lesson learned for a lot of people that that's not an easy way out. So listen, I think people seem to learn repeatedly, or actually not all that often because we don't really have that many, but every time it's not an easy way out. It is used by and large for exactly that reason, to force the unions to the table. It's not a way to renegotiate debt. I can't really think of how many times if that's ever been the case, it was a time to renegotiate debt. It's almost always been a union-related issue.
That's right.
Detroit schools, for example, Robert Bob actually is the guy running the place nowadays, and he's made it pretty clear that whatever they do with the school district there, it's really about forcing the unions to the table. It's not about renegotiating debt.
And so far in Detroit, a place that does have declining assessed value, a place that does have declining population, the unions, not just the teachers union, but the other unions have been intractable in their demands. And they've had to close half the schools to get their budget back in balance. So Rob Bob's doing a great job, but he's got his hands full there.
It's very difficult.
Yeah, probably the developing story in the muni market might be Detroit, Michigan, after the story plays itself out in Alabama. So, well, that's all we have time for. See, our time's up here, so I want to thank my panel for sharing their time and their expertise, and we hope we've dispelled some of the misinformation and brought some clarity to the scope and the scale of this project, because the muni market's a big market and it tends to get a lot of attention because the number is so high. So we hope we've imparted some practical credit expertise to you, but let's not end the conversation there. Please send any questions or comments you have into your representative, and we'll answer them either online or in person. We're always available. We look forward to having you join us again on the next episode of Full Disclosure. Thanks for your time.